I get it. Everyone's hyped about New Year's resolutions in January, but here's what nobody tells you. The real money moves happen in December. If you wait until 2026 to fix your finances, you've already lost. I've spent the last 5 years studying wealth building patterns, and I can tell you with certainty that what you do in the next 4 weeks will determine whether you start the year ahead or behind. In this video, I'm breaking down 5 specific money moves you need to make before January 1st. These aren't vague tips like save more or invest better. I'm talking about tactical decisions with actual dollar amounts attached. Things that could literally put an extra $5,000 to $15,000 in your pocket by year end. And I'll explain exactly why each one matters and how to execute it step by step. Alright, let's start with the most important move on this list. Maxing out your tax-advantaged accounts. And I know what you're thinking. It's late November. I don't have thousands of dollars lying around. Stick with me, because even if you can't max everything out, understanding this will save you serious money. Here's the deal. December 31st is a hard deadline. After that, you can't go back and contribute to 2025. You miss it, you lose it forever. And that's not just about the contribution. It's about years of compound growth you'll never get back. So let's talk about the big 3 you need to focus on. First up, your 401k. For 2025, you can contribute up to $23,500 if you're under 50, or $31,000 if you're 50 or older. Now, most people aren't going to hit that limit, and that's fine. But here's what you need to do right now. Check your year-to-date contributions. Log into your 401k account, see where you're at, and figure out if you can bump up your contribution percentage for December. Even an extra $100 or $200 matters. Second is your IRA, either traditional or Roth. The limit here is $7,000 or $8,000 if you're 50 plus. The good news? You actually have until April 15th, 2026 to contribute to your 2025 IRA. But don't use that as an excuse to procrastinate. If you have the cash now, do it now. Why? Because that money could be growing in the market for an extra 4 months instead of sitting in your checking account earning basically nothing. And this is the one most people sleep on, your HSA or health savings account. If you have a high deductible health plan, you can contribute $4,150 for individuals or $8,300 for families in 2025. This is literally the best retirement account that exists. You get a tax deduction going in, it grows tax-free, and you can withdraw it tax-free for medical expenses. It's triple tax advantaged. Nothing else comes close. Now let's run a real example so you can see the actual impact. Let's say you're in the 24% tax bracket, and you manage to contribute an extra $5,000 across these accounts before year end. That's $1,200 you're saving in taxes right there. But it gets better. Assuming a conservative 7% annual return, that $5,000 grows to over $38,000 in 30 years. And because it's in a tax-advantaged account, you're not paying taxes on that growth along the way. Here's the move. This week, not next month, log into your accounts, check your contribution limits, see what room you have left, then adjust your December contributions to squeeze in as much as you can afford. Even if it's just an extra $500 or $1,000, you're literally giving yourself free money through tax savings and compound growth. The people who get rich aren't the ones making excuses about why they can't max out their accounts. They're the ones who figure out how to make it happen, even if it's not cutting back on holiday spending or pushing that purchase to January. Alright, move number 2 is for anyone who has money in the stock market. And if you don't, you should after watching this video. Actually, if you're not investing yet, I have other videos on my channel about ETF investing and how to get started. Go check those out first, then come back to this. But for everyone who's already in the market, we're talking about tax loss harvesting and portfolio rebalancing. Now, I know those sound like fancy Wall Street terms, but trust me, this is simpler than you think and could save you thousands in taxes. Quick disclaimer before we dive in, I'm not a tax professional, and tax laws can vary based on your specific situation and location. Everything I'm sharing here is for educational purposes. Always verify this information with a qualified tax advisor or accountant before making any moves. Alright, with that out of the way, let's get into it. Let's start with tax loss harvesting. Here's the basic idea. If you bought a stock or fund this year and it's down, you can sell it at a loss before December 31st and use that loss to offset any gains you made from other investments. So let's say you sold some Bitcoin earlier this year and made $10,000. Normally, you'd owe capital gains tax on that, around 15 to 20% depending on your bracket. But if you also have a stock that's down $5,000, you can sell that loser, and now you only owe taxes on $5,000 of gains instead of $10,000. You just saved yourself $750 to $1,000 in taxes. But here's where it gets even better. If your losses exceed your gains, you can use up to $3,000 of those losses to offset your regular income. And if you have more losses than that, you can carry them forward to future years. This is literally free money sitting on the table that most people ignore. Now, one critical thing you need to know: the wash sale rule. If you sell a stock at a loss and then buy that same stock back within 30 days, the IRS will disallow your tax deduction. So if you're harvesting losses, make sure you're either waiting 31 days before buying back in, or you're moving into a different investment entirely. Don't try to game the system here. The IRS is watching, and it's not worth the risk. Okay, now let's talk about rebalancing. This is something you should be doing anyway, but year-end is the perfect time. Here's what I mean. Let's say at the beginning of 2025, you decided you wanted 60% stocks and 40% bonds. Well, the stock market had a great year, so now you might be sitting at 70% stocks and 30% bonds. You're taking on more risk than you planned. Rebalancing means selling some of those stocks and buying more bonds to get back to your 60-40 split. And here's the genius part. If you're doing this in a tax-advantaged account like an IRA or 401k, you can rebalance without owing any taxes. It's completely tax-free inside those accounts. But if you're rebalancing in a taxable account, this is where you combine it with tax loss harvesting. You're already looking at your positions, identifying winners and losers. Sell the losers for the tax benefit, use some of those proceeds to rebalance, and boom, you've optimized your portfolio and reduced your tax bill at the same time. Here's your action plan. Log into your brokerage account this week. Look at every position you own. Is anything down for the year? Those are your tax loss harvesting candidates. Then look at your overall allocation. Are you overweight in tech? Did one sector dominate your portfolio? Rebalance to get back to your target allocation. If you're thinking, this sounds complicated, I don't want to mess it up, most brokers have tools that can help you identify tax loss harvesting opportunities. Fidelity, Schwab, Vanguard, they all have this built in. Or you can use a robo-advisor like Betterment or Wealthfront that does this automatically. But don't let perfection be the enemy of good. Even if you just harvest 1 or 2 losses, you're ahead of 90% of investors who do nothing. The wealthy do this every single year without fail. It's not because they're smarter, it's because they understand that tax optimization is just as important as picking good investments. December 31st is the deadline. After that, you're stuck with whatever tax bill you have. Don't leave money on the table. Alright, move number 3 is something almost nobody does, but it's one of the most powerful things you can do for your money: running a complete year-end financial audit. And I'm not talking about some complicated spreadsheet with 50 tabs. I'm talking about a simple, honest look at where your money actually went this year and where you stand right now. Here's why this matters. You can't improve what you don't measure. Most people have no idea what their actual net worth is. They know their salary, sure, but they don't know the real number. Assets minus liabilities. And that's the only number that actually matters when it comes to building wealth. So step 1 of your financial audit is calculating your net worth. Grab a piece of paper or open up a notes app. On one side, list everything you own that has value: your checking account, savings account, retirement accounts, investment accounts, the value of your car, your house if you own one. Add it all up. That's your assets. On the other side, list everything you owe: credit card debt, student loans, car loans, mortgage balance, any other debt. Add that up. That's your liabilities. Now subtract liabilities from assets. That number, positive or negative, is your net worth. And here's the thing, it doesn't matter if that number is negative right now. What matters is that you know it, and you're going to track it going forward, because you can't get from point A to point B if you don't know where point A is. Now, here's what's crazy. When I did this for the first time, I thought I was doing pretty well financially. But when I actually calculated my net worth, I realized I had way more debt than I thought and way less in investments. It was a wake-up call. But that wake-up call is exactly what I needed to get serious about building wealth. Step 2 is the subscription and expense purge. This is where you're going to find free money sitting in your budget. Log into your bank account and credit card. Go through the last 3 months of transactions. I guarantee you're paying for subscriptions you forgot about. Netflix you're not watching. That gym membership you haven't used since February. The app subscription that renews every month that you signed up for once and never canceled. Here's what I want you to do. Make a list of every single recurring charge. Then ask yourself, did I use this in the last 30 days? If the answer is no, cancel it right now. Don't tell yourself you'll use it next month. You won't. And look, even if each subscription is only $10 or $15, that adds up. 5 subscriptions at $15 each is $75 a month. That's $900 a year you're throwing away on things you don't use. Invest that $900 instead, and in 30 years at 7% returns, that's almost $7,000. You're literally paying thousands of dollars for the privilege of not canceling subscriptions. Step 3 is identifying what worked and what didn't in 2025. This is the reflection piece. What financial decisions did you make this year that moved you forward? Maybe you got a raise. Maybe you started investing consistently. Maybe you paid off a credit card. Write those down and celebrate them. Seriously, acknowledge what went well. But also, and this is harder, look at what didn't work. Did you overspend on eating out? Did you buy things on impulse that you regret? Did you let your emergency fund sit at zero all year? Be honest with yourself. Not to beat yourself up, but to learn. Because the definition of insanity is doing the same thing and expecting different results. Here's the power of this audit. When you know your net worth, when you've cut the dead weight from your expenses, and when you've identified your money patterns, you're setting yourself up to actually change things in 2026. Most people stumble into the new year with no plan, wondering why nothing changes. You're not going to be most people. So this week, I want you to block out 2 hours, just 2 hours. Sit down with your finances, calculate your net worth, cancel those subscriptions, reflect on the year. It's not fun, I know, but I promise you, this 2-hour investment will pay dividends for the rest of your life. And once you have this baseline, you can track your progress every quarter or every year and actually see yourself getting wealthier over time. The wealthy aren't wealthy by accident. They know their numbers, they track their progress, they optimize constantly, and it all starts with an honest audit of where you are right now. Alright, move number 4 is probably the most uncomfortable one on this list, but it's also potentially the most lucrative, negotiating your salary or bonus. And December is literally the perfect time to do this. Most companies do performance reviews and budget planning in December and January. If you wait until March or April to ask for more money, the budget is already set. The decisions have been made. But if you have the conversation now, you can actually influence those decisions before they're finalized. Here's the reality. Your company is not going to just give you more money out of the kindness of their heart. They're going to pay you the minimum amount required to keep you from leaving. That's not evil, it's just business. Which means if you don't ask, you don't get. So let's talk about how to actually do this. Step 1 is building your case. What did you accomplish this year? Did you bring in new clients? Save the company money? Take on additional responsibilities? Write it all down. Be specific. Use numbers wherever possible. Don't say, I worked really hard this year. Say, I managed the Smith account, which brought in $250,000 in revenue. I streamlined the onboarding process, which reduced customer complaints by 30%. See the difference? One is vague and emotional. The other is concrete and business focused. Step 2 is knowing your market value. Go on websites like Glassdoor, Payscale, or Levels.fyi and research what people in your role are making. If you're making $70,000 and the market rate is $90,000, you have a very strong case. Step 3 is the actual conversation. Schedule a meeting with your manager. Start by laying out what you've accomplished, then make your ask. Here's a script. Based on my contributions this year, and after researching market rates for my role, I'd like to discuss adjusting my compensation. I'm looking for a salary increase to X amount. They'll either say yes, no, or let me think about it. If they say they need to think about it, ask for a specific timeline. If they say no, ask what you'd need to accomplish to earn a raise. This either reveals legitimate reasons you can work on, or it tells you it's time to start looking elsewhere. Here's the thing, even if you don't get the full amount, you'll probably get something, and that compounds over time. A $5,000 raise today, assuming modest 3% raises every year after, is worth over $200,000 over 30 years. $200,000 because you had one uncomfortable conversation. So this week, document your accomplishments. Research your market value. Schedule that meeting. The worst thing they can say is no. And if they say no, you have valuable information about how much they value you. Stop leaving money on the table. You've earned it. Now go ask for it. Alright, the 5th and final move is setting up financial automation for 2026. And this is the one that's going to make everything else stick. Because here's the truth. Willpower doesn't work. motivation fades. But systems run on autopilot, whether you're feeling motivated or not. The biggest mistake people make with money is relying on discipline. They tell themselves, in January, I'm going to be better about saving and investing. And then February rolls around, life gets busy, and nothing changes. But when you automate your finances, you remove yourself from the equation. The money moves before you have a chance to spend it. Let's talk about how to set this up. Step 1 is the pay yourself first system. As soon as your paycheck hits your account, money automatically gets transferred to your savings and investment accounts before you can spend it. Log into your bank and set up automatic transfers. The day after your paycheck deposits, have money automatically moved to 3 places. First, your emergency fund until you have 3 to 6 months of expenses. Second, your investment account, your 401k, IRA, or brokerage account. Third, any other savings goals like a house down payment or vacation fund. Make these transfers automatic and immediate, not at the end of the month when you see what's left over. Because there will never be anything left over. Expenses expand to fill whatever money is available, but when you pay yourself first, you're forced to live on what's left. And you know what? You'll adjust. You'll cut the unnecessary stuff and be more intentional with spending. Step 2 is automating your bills. Every recurring expense should be on auto pay. Rent, utilities, insurance, phone bill, subscriptions, all of it. This way you never miss a payment and tank your credit score, and it removes the mental load of remembering to pay bills. Step 3 is automating your investments. Most brokerages let you set up automatic purchases. Want to invest $500 a month into an S&P 500 index fund? Set it to automatically buy on the 15th every month. You don't have to think about it or time the market. It just happens. This is dollar cost averaging. By investing the same amount every month, regardless of market conditions, you buy more shares when prices are low and fewer when prices are high. Over time, this removes emotion from investing. The biggest enemy of returns isn't market crashes. It's investors panicking and selling at the wrong time. When it's automated, you can't panic sell. Here's your action plan. Before December 31st, log into your accounts. Set up automatic transfers from checking to savings and investments. Set up automatic bill pay. Set up automatic investment purchases. 30 minutes of work that will transform your entire financial year. The wealthy don't stay wealthy because they have incredible willpower. They stay wealthy because they have systems that make the right financial decisions automatically. So while everyone else is making New Year's resolutions that they'll break by February, you're going to have a system that runs whether you're motivated or not. That's how you actually build wealth. Not with willpower, with automation. Alright, there you have it. 5 money moves that will set you up for a killer 2026. Max out those tax-advantaged accounts, harvest your losses, and rebalance your portfolio, run your financial audit, negotiate that raise, and automate everything. These aren't complicated. They're just things most people are too lazy or too scared to do. Here's the reality. You can watch this video, nod along, and do nothing. Or you can pick 3 of these 5 moves and execute them this week. That choice is the difference between starting 2026 ahead or behind. If you found this helpful, hit that subscribe button because I drop new money content every week. Thank you for watching. I'll see you in the next one.